If you're in the construction business, you know that risk is just part of the job. You probably hear the words insurance and bonds thrown around all the time, sometimes like they're the same thing. But they're not even close. So today, we're going to break it all down: what they are, how they work, and how they team up to keep your business safe. Here's how we'll do it. First, we'll look at the core problem, the constant risk you face. Then we'll get into your shield, that's insurance. After that, we'll demystify your guarantee, that's bonds. Then we'll put them head to head, see how it all works in the real world, and finish up by asking the big question: are you really protected? All right, let's kick things off with the reason we're even having this conversation. The simple fact that in construction, risk is everywhere, all the time. Seriously, take a second and think about it. What's the one thing that keeps you up at night? Is it finding good help? The price of lumber? Or is it that one phone call that could change everything? Well, that's pretty much it right there. It all boils down to a dispute, a single unexpected event, an accident on site, a disagreement with a client, tools getting stolen. Any of it can spiral into a huge financial problem. The reality is, a dispute can pop up out of nowhere, and if you're not ready, it could sink the whole ship. So this leads us right into your first line of defense, the thing I like to call your personal shield, your construction insurance. At its heart, insurance is a pretty simple deal. It's a two-party contract. There's you, the contractor, and there's the insurance company. You pay them a premium, and they promise to cover your losses if something bad happens. And here's the key: insurance is there to protect you and your business. And you can think of these common policies as different parts of that shield. General liability protects you if someone says you caused property damage or injury. Workers' comp is for your crew. Builder's risk covers the actual building while it's under construction. And of course, you've got policies for your trucks and your tools. Each one guards a different part of your business. Okay, let's flip the coin over now. We need to talk about surety bonds, which are so often mistaken for insurance. But a bond isn't your shield. It's your public guarantee. It's a completely different animal. And this right here really gets to the core of the mix-up. It's a super common mistake to think a bond is just another policy. But it's not. They both involve money and protection, sure, but how they work is fundamentally different. Now, if you remember one thing about bonds, make it this: a bond is a three-party agreement, and its whole purpose is to protect your client, the project owner. It's you making a promise that you'll do the job right, and that promise is backed up by a financial guarantee. It protects them from you, not the other way around. So let's meet the three players in this agreement. First, there's you, the contractor. You're called the principal. Then there's your client, the one who wants the guarantee. They're the obligee. And finally, there's the surety. That's the company that issues the bond and guarantees your promise to the client. It's this triangle relationship that makes a bond what it is. In construction, you'll mainly run into these three. A bid bond says, hey, if you pick me, I'll actually sign the contract. A performance bond guarantees you'll finish the job according to the plans. And a payment bond guarantees that you'll pay your subs and suppliers, so the project owner doesn't end up with liens on their property. All right, so we know what they are. Now for the main event. Let's put insurance and bonds side by side. This is where the confusion really clears up. Just look at this breakdown. Insurance, 2 parties. Bond, 3 parties. Who gets protected? With insurance, it's you. With a bond, it's your client. But now we get to the biggest difference of all. Who foots the bill when there's a claim? And here it is, the absolute bottom line. With an insurance claim, the insurer pays, and that's usually the end of it. But with a bond claim, it's more like a line of credit. The surety company will step in and pay your client to make things right. But then they will turn around and come to you to get that money back. You have to reimburse them for the full amount. So that's the theory. But how does this all actually play out in your day-to-day business? Let's talk about how this stuff works on the ground. Take a look at this real-world rule from Florida. For most businesses, you need workers' comp once you have 4 employees. But for construction, the rule is just 1 employee. That even includes you, the owner. This shows you how seriously the law takes risk in this industry. Insurance isn't just a good idea here, it's a legal requirement. And here's some fantastic practical advice from another contractor. Managing risk isn't just about you. It's also about making sure your subcontractors are covered. Pros will make their subs sign agreements and show proof of their own insurance. Why? Because if your sub makes a mistake, you don't want to be the one left holding the bag. Now let's talk about getting bonded. You don't just go out and buy a bond off the shelf. Nope. Because the surety company is guaranteeing your work, they need to be sure you're a good bet. They're going to put your business under a microscope in a process called underwriting. So what are they looking for? It really comes down to what the industry calls the 3 Cs. First, character. What's your reputation? Do you do what you say you will? Second, capacity. Do you actually have the equipment, the team, and the experience to handle the job? And third, capital. Are you financially stable? Being able to get bonded is a massive stamp of approval for your business.
Okay, we've walked through the what, the why, and the how of insurance and bonds. Let's wrap this up and bring it all home with the one question that really matters.
You see that phrase on trucks and websites all the time. Bonded and insured. It's so much more than just a couple of words. It's a signal. It tells everyone, your clients, the government, that you are a serious professional. It says you're reliable, you're financially secure, and you stand behind your work. It builds trust before you've even driven the first nail. So I'll just leave you with this final thought. Ask yourself, is your business just covered, or is it guaranteed? Do you just have a shield to protect you when things go wrong? Or do you also have a guarantee that proves to the world that you'll deliver on your promises? Knowing that difference, that's the key to building a business that can weather any storm.